Well, let's start first of all with what it was you set out to build. So what did you know back then? How did you construct it? What did you think you were going to create?
Yeah, back then it was really about creating very, very high margin cash flow. It was about finding projects that were going to be in production in the next 12 to 18 months and finding projects where we could generate 30, 40% returns on cash. Reality was, if you're getting 30 to 40% returns on cash, there's probably something wrong with either the underlying asset or the company. And being very candid with you, there's a lot of learnings in terms of reaching for immediate cash flow that we were able to build upon and actually work out into a very favorable format for our investors and return for our investors. But to be honest, there's a long game to this, and there's a right way of building the right exposure that I don't think we fully appreciated back in 2013, 2014. That when we started rebuilding up what is now VOX, we fully understood, fully grasped, and what really yields much better long-term results for shareholders.
So let's talk about that. That's interesting because we've been speaking to a lot of royalty companies recently. They've each got their own nuanced difference. They tell us about how they're going about it, and you've obviously got yours. Okay, you've been going, what would you say, 6-7 years? What are you going, 2012? When are we going, 2014? Six years?
Business was incorporated in 2014.
Right, okay.
Yeah.
So you've been at this a while, and you talked about there's learnings, and those learnings could be, right, we can get quick revenue, but I think you're indicating that that's probably not the right way to do it as far as you're concerned, or you can get kind of long-term value. So talk to us about which model you selected and why you rejected the other one.
Yeah, the original model was make a real big push for cash flow. We also invested in something that I think really adds a lot of value to our shareholders and our investors is we were investing in the downturn of a cycle. And so we saw what it looked like in the upturn, and we saw what it looked like in the downturn. Compared to a lot of the new entrants that haven't really gone through a real true bear cycle, they're seeing the bull cycle, and that's great. But understanding what wins in the long term, having gone through these cycles, made a big difference. And so it really refocused us on real quality of asset, having people that really understood the quality of those assets, which means they're very technical in background and expertise. And so while there is no right or wrong answer in the royalty space, I think you'll find there's people and companies at either end of the spectrum. What we found is buy good value on good projects in a royalty format. If you do that, you are going to win. And the companies that have done that, like Franco and Royal and Wheaton consistently, have outperformed and delivered exceptional returns for their shareholders, both in good cycles and bad cycles. But I think to their credit, they really focused on quality of project, and that's carried weight for them in terms of delivering returns to their shareholders.
Okay, but what's the impact of that on your bottom line? Because again, you've got to weigh up, getting cash in, which then gives you optionality to do different things, or waiting for the cash to come in because you believe in the fundamentals of the transaction that you've done and the royalties that you've picked up. So again, what were the things that you guys are having to weigh up? Or was it a case of actually we learnt the right way to do it as we were doing it because it was early days? You guys were a lot younger.
Yeah, no, fair point. Some of it was absolute learnings. Some of it was absolute learning from deals that didn't work out, or deals that didn't work out that we made work out, and then also understanding, taking those learnings in, applying them, getting smarter, getting better, and also being students of what has worked in the royalty space and being disciplined to really facilitate that model for our shareholders. And so, when we say we're creating long-term value, long-term growth in our cash flow, we're right now at that inflection point. We're essentially treading water for, say, the next 12 months on a cash flow basis. That's just organic. When we hit 2022 is where we really hit our legs in terms of exponential growth in cash flow. And there will be accretive opportunities that come to us before that. But what we've done is we've built our portfolio around maybe assets that were 12, 24, maybe even 36 months out from production that we could buy at great value because they were also great assets. That made sense to bring in instead of, say, reaching for a transaction that might provide very short mine life, very short-term cash flow, or a very marginal asset that you then have that risk of that asset coming offline or not producing as expected. We've been able to really lower the risk of our overall portfolio while still giving investors what they should expect with any small cap company, exponential level growth and exponential growth in all the categories that matter, and especially cash flow and producing assets in the case of VOX.
Okay, we're going to come back to exponential, which you've mentioned 4 times in a second, but let's get back to the model, okay? Because you've kind of described your precious metals and
Yep.
the very basic summary. But let's get into, because you've got a theory or a thesis around which geographies you prefer. You are predominantly precious metal, but 65%, because you've got base metal, you've got EV, and you've got some bulk in there too. So you're mixing it up a bit. You're hedging your bets. So why don't you tell us and break down what is the thesis behind your royalty company? What do you believe in?
One of the really key things in VOX, and we might get into this in more detail in a little bit, Matthew, but we went out and acquired intellectual property in the form of a royalty database of 7,000 proprietary royalties that many of the comps and peers, those assets and those opportunities, they're completely blind to. It's under the radar screen. And what that's allowed us to do is really drive competitive advantages in terms of sourcing opportunities. Now, Australia happens to be where 3 of our 4 key business development executives are Australian citizens and have deep backgrounds in Australia. But we also have significant intellectual property there and then deal sourcing relationships. You overlay that IP, that existing history and just know-how in the market with that Australia, and especially Western Australia, it's the best mining jurisdiction on the planet. And in terms of gold endowment, you've got more gold opportunities than you do really anything else in that marketplace for royalties. So it's really, Australia has been kind of a burgeoning opportunity of exposure to royalties for us at great value, and that will continue. That being said, our intellectual property goes beyond Australia. Our sourcing networks go far beyond Australia. But right now we find such great value with such great assets that that competitive advantage continues to be at the forefront of everything that we're doing.